Option risk and optionality, analyzing risks and implications in finance. Gender overview, introduction to options, option risk and overview, explicit optionality, implicit optionality, comparative analysis, explicit versus implicit optionality. Definition and types of options. Call options. Call options provide the holder the right to purchase an underlying asset at a predetermined price before expiration. Put options. Put options give the holder the right to sell an underlying asset at a specified price prior to expiration, useful for hedging. Trading strategies. Each type of option caters to different trading strategies and risk profiles, allowing investors to approach the market with various tactics. Basic concepts, calls and puts, call options. Call options provide the right to buy an asset at a specified price, allowing profits when asset prices rise. Put options. Put options give the right to sell an asset at a specified price, enabling profits when prices fall. Importance of options trading. Understanding call and put options is essential for making informed trading decisions in the financial markets. Key components of an option contract. Strike price. The strike price is the price at which the option can be exercised, impacting its value and profitability. Expiration date. Expiration date is the deadline for exercising the option. It significantly influences the option's strategic value. Premium. Premium is the cost of purchasing the option, which is crucial for evaluating potential profitability and investment risk. Definition of option risk. Understanding option risk. Option risk involves potential losses resulting from uncertainties in option trading, highlighting the importance of risk management. Factors influencing option risk. Various factors contribute to option risk, including market volatility, changes in the underlying asset price, and time decay. Mitigating option risk. Effective strategies must be employed to mitigate option risk, such as diversification and hedging techniques. Types of option risks. Market, credit, and liquidity risk. Market risk. Market risk involves potential losses due to price fluctuations in the market. Understanding this risk is vital for investors. Credit risk. Credit risk relates to the counterparty's ability to meet their financial obligations. Assessing this risk is essential for secure transactions. Liquidity risk. Liquidity risk concerns the ease of buying or selling an asset without causing significant price changes. This risk impacts trading decisions. Measuring and managing option risk. Option risk metrics. Measuring option risk involves analyzing metrics like delta, gamma, and vega to assess potential price movements and volatility. Risk management strategies. Effective risk management strategies include diversification and position sizing, which help to mitigate potential losses in trading. Characteristics of explicit optionality. Clear terms and conditions. Explicit optionality provides clear terms and conditions, ensuring certainty regarding rights and obligations for all parties involved. Informed investor decisions. Explicit nature of optionality allows investors to make informed decisions tailored to their individual risk appetite and investment strategy. Examples of explicit optionality in financial instruments. Stock options. Stock options give employees the right to purchase company shares at a predetermined price, offering potential financial gains. Warrants. Warrants are long-term options that allow the holder to purchase a company's stock at a specific price, providing investment flexibility. Convertible bonds. Convertible bonds are hybrid securities that can be converted into a predetermined number of shares, balancing risk and reward. Advantages and disadvantages of explicit optionality. Enhanced flexibility. Explicit optionality provides investors with greater flexibility to adapt to market changes and make strategic decisions. Potential for profit. Investing in explicit optionality can lead to substantial profits if the market moves favorably, maximizing returns. Risk of total loss. Significant downside of explicit optionality is the risk of losing the entire premium investment if options expire worthless. Understanding implicit optionality. Strategic business decisions. Implicit optionality often emerges from strategic decisions that offer firms operational flexibility and adaptability. Economic factors. Economic factors can influence implicit optionality, affecting companies' financial outcomes and operational strategies. Risk evaluations. Recognizing implicit optionality is crucial for effective risk evaluations, enabling better decision making under uncertainty. Examples of implicit optionality in financial contexts. Project financing optionality. Project financing often includes implicit optionality, allowing businesses to postpone investment based on market conditions. Investment opportunities. Investment opportunities may embed optionality, enabling investors to defer actions until optimal market conditions arise. Risk assessment. Understanding implicit optionality is crucial for assessing risks in financial contexts, aiding investors in making informed decisions. Impact of implicit optionality on risk assessment. Flexibility in decision making. Implicit optionality introduces greater flexibility in decision making, allowing for more adaptive strategies in risk assessment. Obscured risks. While implicit optionality can enhance decision making, it may also obscure underlying risks that require careful analysis. Explicit versus implicit optionality. Explicit optionality. Explicit optionality is clearly defined within contracts, offering specific rights or choices to investors. Implicit optionality. Implicit optionality is often context dependent and inferred, requiring investors to analyze underlying conditions. Investment decisions. Understanding both explicit and implicit optionality enables investors to make more nuanced and informed decisions. Impact on financial strategies and decision making. Understanding optionality. Understanding the concept of optionality is crucial for developing effective financial strategies, whether explicit or implicit. Benefits of optionality. Explicit optionality offers clear advantages in certain investment scenarios, enhancing potential returns while managing risks. Drawbacks of optionality. Implicit optionality may introduce complexities that can complicate decision-making processes, potentially leading to suboptimal strategies. Conclusion. Importance of option risk. Understanding option risk is essential for making informed investment decisions and managing potential losses effectively. Explicit versus implicit optionality. Grasping the differences between explicit and implicit optionality allows investors to tailor their strategies according to varying market conditions. Enhanced risk management. Knowledge of option risk and optionality contributes to better risk management, helping investors optimize their portfolios. Thank you.